The Transactional Net Margin Method, TNMM, plays a crucial role in transfer pricing by ensuring that transactions between related parties adhere to the arm's length principle. This method is applicable to both specific transactions and for testing an entity at the net level in the profit and loss (P&L) statement. TNMM, unlike some other transfer pricing methods, does not compare the prices of specific transactions, but instead focuses on the profitability of the tested party or transaction in relation to its comparables. By focusing on net margins, it provides a useful and flexible tool for businesses to determine if their intercompany transactions are conducted at market rates. This video will explore the key principles of TNMM, how it works, and the advantages it offers in transfer pricing analysis. The methodology's application in practice will also be discussed, along with examples to clarify its implementation and relevance. TNMM evaluates the net profit margins that arise from a controlled transaction between related entities. These margins are then compared to the net margins earned by independent, comparable companies that are involved in similar activities. The aim is to ensure that the related entities' net profits reflect what would be expected under market conditions where transactions are carried out between independent enterprises. The TNMM focuses on the net operating margin, meaning it considers a company's overall financial performance rather than the specifics of individual transactions. It is commonly used when one party to the transaction makes a routine contribution, and the key factor to consider is whether that party's profitability is aligned with industry standards. Number 1. Selection of the tested party. The TNMM typically focuses on the entity that is the least complex within the group structure. The tested party is often the company that performs routine, low-risk activities, such as contract manufacturing or distribution services. By selecting the least complex entity, TNMM ensures that the comparison with third-party companies remains accurate and reliable. Number 2. Choosing the profit level indicator. TNMM requires the selection of a profit level indicator that appropriately reflects the tested party's profitability. Common PLIs include operating margin, operating profit to sales, return on assets, operating profit to total assets, Berry ratio, gross profit to operating expenses. The choice of PLI depends on the nature of the tested party's business and the functional analysis. Number 3. Comparability. Analysis. TNMM requires identifying independent comparables that engage in similar activities to the tested party. This involves analyzing companies in the same industry with comparable functions, risks, and assets. An important step in applying the TNMM is ensuring that the comparables operate under similar market conditions and regulatory environments. Number 1. Flexibility. TNMM can be applied to a wide range of industries and business models, which makes it a flexible tool. It is particularly useful for entities engaged in routine, low-risk activities such as manufacturing, distribution, or contract R&D. This method can accommodate various profit level indicators, making it adaptable to different types of companies and industries. Number 2. Focus on net margins. By focusing on the net margin, TNMM avoids some of the complexities associated with price comparisons in other methods, such as the comparable uncontrolled price method. This allows for a more straightforward analysis in situations where transaction-level data may not be readily available. Number 3. Applicability to routine functions. TNMM is ideal for testing entities that perform routine functions within a multinational group. These entities typically have limited risks and are expected to earn a stable, modest return in line with industry standards. The method is less sensitive to the precise terms of individual transactions and instead assesses whether the tested party's overall profit margin is reasonable. Number 1. Selection of comparables. One of the most critical challenges in applying TNMM is identifying appropriate comparables. Finding companies that perform similar functions and operate in similar market conditions can be difficult, especially in niche industries. Furthermore, tax authorities often scrutinize the selection of comparables, which can result in disputes. Number 2. Adjustments for differences. Even when comparables are identified, differences in risk profiles or market conditions between the tested party and comparables may necessitate adjustments. These adjustments can be complex and may require detailed financial analysis to ensure that the comparison remains valid. Number 3. Tax authority. TNMM has been subject to increased scrutiny by tax authorities in recent years. Authorities may challenge the selection of comparables or question the appropriateness of the profit level indicator. As a result, businesses must ensure that they can adequately justify their approach and provide thorough documentation to support their analysis. The TNMM is a widely used and flexible approach to transfer pricing. It is particularly useful for testing entities that perform routine functions within a multinational group. By focusing on net margins, TNMM simplifies the transfer pricing analysis and allows for a broader view of the tested party's profitability. However, businesses must carefully select comparables and be prepared to make necessary adjustments to account for differences between the tested party and the comparables. The method's flexibility, coupled with its challenges, makes it essential for companies to maintain thorough documentation and robust financial analysis when applying TNMM in their transfer pricing strategy. As tax authorities continue to scrutinize transfer pricing practices, TNMM will remain a critical tool for businesses in ensuring compliance with the arm's-length principle.